Welcome back, everyone. Today on the Joseph Carlson Show, we have 10 companies. Yes, 10 of them that are both incredibly high quality and their buys today. Intrinsically, they are undervalued. Now, some of these companies you're going to recognize. They're ones that we've talked about before that I'll give you a quick update on. But there's a couple in there that I think are new, ones that you won't recognize. So I'm excited to go over this list. Now, of course, we also have some other news to get to. Tesla just had some rather disappointing news. Their delivery sank by 13%. So Tesla's going through a lot right now, and to no one's surprise, they're delivering less vehicles, and this is part of the problem of brand erosion. Now, even though this has happened and Tesla's selling fewer vehicles, we have Tesla stock going in the green. Why is Tesla up 5.5% today, even though they're selling fewer vehicles? We'll be going over that. We also have big news in the credit card industry. Visa apparently has bid $100 million to take over the credit card deal away from Mastercard to get on the iPhone. You know the iPhone Apple Card? That's a Mastercard. Visa wants it. They're willing to pay $100 million, and even Amex is in the bid. They have different negotiating strategies, and we're going to be breaking this down. And then finally, we also have this news that Amazon apparently made a last-minute bid to buy TikTok. So last minute in these negotiations, Amazon just slipped in this deal saying, hey, we'll just buy the entire thing. We're going to be going over this as an Amazon shareholder, what I think of Amazon potentially owning TikTok, and the likelihood of this deal going through. So we have a lot to get to in this episode. Let's go ahead and jump in. Now we'll start off by going through the companies that are both high quality and their buys today. And we kick things off with none other than Google. Now I know I've highlighted this one many times, so I'm not going to rehash the entire case, but I just want to point out a few basic things about Google. Google is trading at a 17 forward PE ratio based on 2025's earnings estimates, meaning this year it's trading at a 17. In 2026, it's trading at an estimated 15 times earnings per share estimate. A 15 times multiple is very cheap on next year's earnings. To put this in context, anytime one of the Magnificent Seven, or rather the big tech companies, ones like Meta, Netflix, Google, Amazon, Microsoft, have traded anywhere close to a 15 to 17 times, that's been a good time to buy those stocks. If you look at any of the historical valuations of Google, Meta, or Netflix, and you look at when they traded at a 15 to 17 forward PE ratio, those are really good times to buy those companies. Now, other people have suggested, I think accurately so, that the company is more expensive on a cash flow basis. If we look at the free cash flow yield, it trades at a 2.6 when you're factoring in stock-based comp. So it's far more expensive on a free cash flow basis than an earnings basis. But this is something that I'd like to also break down. What Google's doing right now is pretty incredible because their free cash flow in 2022 was $70 billion. That's in the trailing 12 months. So 2022 Q1, they had $70 billion. And how much in CapEx were they doing in 2022 Q1? Well, we can take a look at that right here. We have 2022 Q1. They were doing $28 billion. The free cash flow they're doing today is $72 billion. So the free cash flow they're generating has gone up slightly since 2022. Not much of a change there, but it hasn't gone down. What else has changed over that time period? Well, the amount of CapEx they've done has gone from, in Q1 of 2022, that $28 billion, to last quarter, $52 billion. So they've added on an incremental $20+ billion in CapEx, and during that time period, their free cash flow has stayed the same. Meaning that Google is doing dramatic investments into infrastructure, into cloud computing, into all of these very expensive things, and their free cash flow has still remained the same. They're not even going down in free cash flow while growing the amount of CapEx this much. Now, I believe they're going to get a positive ROI on that CapEx spend. They're going to make money off of it. So I believe that the free cash flow power today is heavily understated in their current financials. Overall, I think Google's cheap based on the earnings and the cash flow. The only question that I believe remains for Google is the threat of LLMs. Everyone has been using LLMs more and more. ChatGPT and Grok are great applications. I use them all the time, but the question is whether or not this is damaging to Google's business. And in most cases, this is where I believe that the market has it wrong. I think that search volume overall is increasing, both the traditional way to search on Google and with LLMs. I think it widens the pie. It grows the entire market. It doesn't necessarily take away from Google's market share. But if LLMs do disrupt Google, that's one of the current risks of the stock. Now, notwithstanding, I believe this company is discounted, and I think it's a buy today. Next up, we have ASML. This company is a monopoly with incredible growth potential, and it trades at a valuation that I believe is rather attractive today. For example, it trades below a 30 forward PE ratio. Based on 2026's estimates, it's trading at a 22. So the PE ratio is low for this quality of a company that faces no competition so far. It also trades at a relatively high free cash flow yield, because they just earned a ton of money last quarter. If you look at how this company earns money, it can be a bit lumpy. For example, the last quarter's free cash flow was $9.6 billion. It looks like a mistake, but it's not. This is accurate. This company will have a lot of invoices be settled at the same time. So a lot of people will pay the bills all in the same quarter. Therefore, they get all this cash flow. And what have they been doing with this cash flow? They've been buying back shares every single day. Thousands of them. So ASML is deploying this capital back into the company at a time where the shares are depressed. This is exactly what investors want companies to do and what companies' management teams to do. In terms of the future growth potential for ASML, these large lithography machines that they create are in demand right now. We need these high-end chips to do things like iPhones and vehicles that drive themselves. All these sensors, all these smart devices. ASML has a key component in the chip manufacturing process. And even as they do that, we also have the news that countries like the US are becoming a little bit more protectionist. We want more of the chip design to happen in-house. That means more business for companies like ASML, because as there's more countries creating their own chips, they need these machines. So I see a very long runway of growth ahead of this company, and I think it's at a deal today. Now, the third high quality company is one that I actually haven't talked about in a video much until now, which is Equifax. You'll recognize it as one of the three big credit rating agencies. That's where they get their name and kind of their brand. But they actually do a lot more than just a credit rating agency. They're a company that does identification and verification. For example, if you want to know the identity of someone, their work history, who they really are, and ensure that before hiring them, then you use one of Equifax's services. And that's actually grown to be a larger part of this company. Now, one of the interesting things was, this is a company that I've known about for a while, but recently one super investor bought this company. His name's Dev Kantesaria, and he's an incredibly good investor. When I looked at Dev Kantesaria adding this one to his portfolio, I wanted to find out why. Why would he add this company to his portfolio? Because so far what I see with Equifax is a company that's not growing that much. In fact, when we look at some of the numbers here, I see a company that's growing its top line rather slow, around 7.8% top line growth. That's not super fast. And in fact, their forecast for this year is around 5%. So it's a slow growing company. That doesn't seem like one that Dev Kantesaria would want to buy. It's also a company that when we look at the free cash flow on a per share basis, this is the main metric that Dev Kantesaria looks at for any company to assess the intrinsic value. This is also growing slowly. We look at it and it's around the same range for years. Since around 2014 and 15, it's generated around $5 to $6 in free cash flow per share. Last quarter on the trailing 12-month basis, it was at $6.50. So not much growth over a long period of time in free cash flow per share. And that really does raise the question, why is Dev Kantesaria buying this company now? What does he see in it? One thing I know about Dev is that he looks ahead and he invests in companies before they have dramatic changes to their business model. He identifies them ahead of time. He did so with FICO. FICO also looked like a company that wasn't growing that fast. Then it suddenly changed when they implemented dramatic pricing increases. So he got in before that dramatic change in business quality. Now with Equifax, I wanted to ask the same question. What is changing about their business? And I found a couple things when I dove into this. What I found was that Equifax was dramatically changing the structure of their business. Specifically, they were going from an on-premise legacy business model to a cloud business model. And this is a journey that they started way back in 2018. So they've been doing this for some time. But until recently, in fact, at the end of 2024, they have moved 85% of their revenue from the on-premise to now on Equifax Cloud. Now, this has some significant implications because if we look at how they were doing things before, it was a very antiquated way of doing business. For example, the on-premise approach led to complex and fragmented IT environments. The accumulation of siloed databases from various acquisitions resulted in data being stored across multiple systems, making integration and unified data analysis challenging. Additionally, the reliance of physical infrastructure limited the company's agility, making it less responsive to market changes and the evolving needs of their clients. Recognizing these challenges, Equifax initiated a comprehensive digital transformation starting in 2018. So before Equifax Cloud, they had around 63 different legacy databases that they were trying to control all this data and bring clients on. It created all this problems with siloed databases, difficulty launching new products, difficulty offering more value, difficulty increasing prices. So all of this was constrained by technological challenges. Realizing these challenges, they decided to transition to the cloud, primarily using Google Cloud and Amazon Web Services. They now have centralized control over all of this data. No more legacy problems, no more siloed data. Now they can launch unified products across their database. Now, like I mentioned, 85% of their revenue and business is on the Equifax Cloud. They have real-time insights and decisions, multi-data assets at scale, faster, more efficient product to market, embedded AI capabilities, improved speed and performance, always-on stability, built-in security, on and on and on. The amount of real benefits this brings from this transition in this company is immense. It's hard to list off everything this can improve. So I believe the reason that Dev is buying into this company today is because the quality of Equifax, the actual intrinsic quality of the company, is increasing and has increased dramatically over the past couple of years. And Wall Street may not have recognized that yet. If he gets ahead of Wall Street and you see growth in Equifax that's far faster than their historical growth, that's a good time to be buying. So this is one that I'm very interested in. I like the developments of this company. I like the core product that they sell with identification, and I think there's a lot of catalysts for the future. Next up is one that's new to the high quality undervalued list, which is Meta. This is a company that's down 20% from its high. So it's had a substantial dip. It was trading at $7.36 just a couple months ago. Now the price is $5.90. Meta has been a stock that, simply put, I've underestimated. I underestimated the quality of this company, the moat, and the runway of growth. I thought that Meta would stop growing a lot sooner than they have. And from everything I see, like this KPI here we have in Qualtrim, the family daily active people continues to grow. It's just staggering to look at. From 2 billion people using their products every day to now 3.35. They continue to grow, and not only their revenue and optimization of ads, but the amount of people using their services. Not only that, but the stock trades at a cheap price today. A 22 forward PE is not bad. Meta, like the rest of big tech, has suppressed free cash flow because they're doing such huge investments in AI. I happen to believe those investments will have a high return. So even though the free cash flow is a little lower, I don't view it as a negative thing. We've already seen that Mark Zuckerberg can sway the company from efficiency and profitability to huge CapEx investments and focusing on future investments and growth. He can sway the company back and forth however he feels. But overall, the core of the business remains incredibly strong. And this is something where I'm getting more on board to the fact that Meta is just never going to go away. It's a stock that has so many great applications that so many people are using every single day that I don't think it's going to be disrupted anytime soon. I think the company is a high quality company selling at an attractive price. The next one that I'd highlight again is Amazon. I've gone over this one many times, so I'll be brief here. But Amazon trades at a 29 forward PE ratio. Based on next year's earnings, that's at a 25. It's rare that you get Amazon, this company with this much versatility, scalability, so many verticals that they're operating in, so much going on for this company. They're just everywhere, and you're getting it for a 29 forward PE ratio. I think it's rather cheap. When you look at the free cash flow yield, it looks more expensive, but Amazon's a company that does not express its full earnings power and free cash flow power in the current metrics. I'm one of the ones that believes that Amazon could earn considerably more if that was their focus. Back in 2020, they were earning $25 billion in free cash flow. The company has grown substantially since then, with doubling their fulfillment network, growing in artificial intelligence, the cloud computing has grown, and they haven't really grown their free cash flow that much. This is not because they don't have the power to, it's because they're not focused on growing their free cash flow. Amazon is still an immature company. They're not paying dividends. They're not doing buybacks. They're not really doing anything for the shareholder. They're just investing for the future growth of the company. So this is one that's on the more immature side. It's not a big, highly optimized company like Microsoft or Apple, but I think it's a buy today at under $200 per share. I've added a lot to Amazon over the past week. In fact, I've bought over $20,000 of this company in the past 7 days alone. Another company that I still think is high quality, but the market's really beating it up, is Salesforce. Now, this is a clear-cut case to me of sentiment following price. Anytime Salesforce goes down in price because of volatility, people say the company's low quality. It's not a good company. You got Mark Benioff, he's kind of a crazy guy. He says lots of crazy things. So the company's not high quality when the stock price is $270. When the stock price races up to $350, it becomes a high quality company. I don't let the price of the stock dictate my sentiment. Salesforce is an incredibly powerful, diversified company with an incredible amount of pricing power. It has competitors, but there's few companies that offer the same level of capability of Salesforce. They've also capitalized on the agentic product with Agentforce. They're on top of that. They're selling that now as a service. They already have it working. The initial reviews are quite good for it. And the company today trades at a 24 forward PE ratio and a 3.5% free cash flow yield, even adjusting out the stock-based comp. Every single way you look at the company, it's trading attractively priced. The next one that I'll highlight is Booking Holdings. This is a company that trades in the low 20s forward PE ratio and a free cash flow yield of 4.7%, even when you factor in stock-based comp. So why is Booking Holdings trading so cheap? I think it's because of this narrative. This idea that the agents and operators, the AI, will book vacations for you. That's what you hear in every single demo. In fact, one of the first things any AI company demos is how it's able to book a vacation. You can say, find me a hotel at a vacation in this place, and it will go through and it will book it for you. A lot of people believe that that's a significant disruptive threat to Booking Holdings, but I don't really believe that's the case. It could pose some threat in some situation, some level of competition, but in most situations, people don't want AI to go scavenge through 1,000 websites and randomly enter your financial information into a hotel website you've never heard of before. That's not typically how people are going to book vacations. They'd rather go through a trusted intermediary, a company that has brand recognition, that has customer service, that has seamless integration with all of the vacation services. So right now, Booking Holdings is being discounted in part because of the threat of artificial intelligence. But I still believe that Booking Holdings' relationships with these hotels, the relationships with the customers, the seamless integration, user interface, I believe all of that put together makes Booking Holdings a lot more difficult to disrupt than investors believe. So this one right now, I believe, is attractively valued. The next one we have here is a very familiar name, which is Uber. Uber continues to trade, I believe, at a very low valuation compared to its growth because of the threat of robotaxi. And although I see that as a real threat, and I've said this before, there is a 10% chance in my mind that robotaxis does disrupt Uber's business to some extent. But overall, I think it's a very similar situation with robotaxi disrupting Uber as LLMs disrupting Google. I think that overall in both situations, the pie is likely to grow, meaning there's going to be more use cases for vehicles and ride sharing. There's going to be a bigger market overall for this. Uber is going to play a continued role and be part of that marketplace. If you don't believe Uber is going to be heavily disrupted by robotaxis, the company trades at a really attractive price today. Now, these next couple, we get into the food category. This is one that I've avoided for some time, and with a lot of caution and discounting going on in the market, I think it's time to jump back in. We have here Chipotle. Now, I don't own Chipotle anymore, but I made $12,000 off of this stock, investing around $25,000 into it. So it was a super good buy. It was one of my better investments I made, but I sold this stock because it was trading at a 55 forward PE. It's a very expensive PE for a company that's growing fast and has a lot of volatility. But right now, if we look at Chipotle, it's down to a 38. So it's come down a lot. The valuation has dropped significantly over the past year. Chipotle is one of these stocks that anytime you bring it up, there's always people that highlight the last time they went there and how it wasn't a great experience, how their burrito wasn't made correctly. That's the case with food companies. If you look at the reviews of any McDonald's, they will have 2 to 3 star reviews. Not 4 to 5, but 2 to 3. Yet McDonald's is a thriving corporation. People that review companies often are the ones complaining about a bad experience. So you get a very biased sampling. Overall, people are very happy with Chipotle. It's reflected in the numbers. You have more people going to Chipotle, more foot traffic, more revenue growth. They can increase prices because people will pay more for their food. If people didn't like the food, if they didn't want to pay more, they would stop going there. But Chipotle still has growth in their average unit, meaning every single unit's earning more money every single quarter, now up to 3.2 million. So this company's still growing steadily while the stock price is going down. The next stock that I think is attractively valued right now is a high quality restaurant, Texas Roadhouse. Now I haven't mentioned this one for some time because it's been floating around the same stock price, around 170. It's been trading around the same price for around a year, and the earnings power have grown of the company. So Texas Roadhouse is becoming cheaper over time. It now trades at a modest 23 forward PE ratio, 21 forward PE based on 2026's earnings estimates. The free cash flow yield is also not bad at a 3.5%. This is a stock that's growing in its revenue rather fast, 16% year over year. The number of restaurants, meaning they're opening up new locations of their various brands, is also growing around 7% per year, which is a fast pace. We also have ample and predictable and reliable free cash flow generation by this company. They're also doing buybacks, and they maintain a very strong balance sheet. This is a company that only has leverage in the way of capital leases, meaning the only real debt they have is their obligations to pay rent, but they don't have any long-term debt. So this is a company that has a very conservative balance sheet, very low risk of going out of business. Now, Texas Roadhouse is a low margin business, so any type of decline could affect this company. It has a bit more risk as a lower margin company, but I believe it's still well prepared to weather through any type of downturn. They've done it before at smaller scale. So even if the economy slows down, even if they have a little bit of a slowdown or reverse on sales, I think they're going to weather through and continue to gain market share. So right now, I view Texas Roadhouse as attractively valued. So there you have it, 10 high quality companies that I consider to be attractively valued. Now let's go ahead and move on to some news. The biggest piece of news is that Tesla's global vehicle deliveries sank by 13%. Now we can take a look at what this looks like. In Qualtrim, we have the vehicles delivered KPI, and you can see it right here. This most recent quarter, Q1 of 2025, they delivered 323,000 Model 3 and Y. Other models was 12,088. You go back 4 quarters and it was Q1 of 2024. It's around a 13% decline. Now, what is causing this big decline in Tesla deliveries and Tesla sales? Musk's active role in the Trump administration and vocal support for far-right parties in Europe has made Tesla a target of political protests and boycotts in recent months, including some cases by once loyal Tesla owners. This is something that I've been able to see firsthand. In my community on Discord, there's so many people from all over the world. So I can see the reaction of many Europeans and people from Germany, for example, of what they think of Elon Musk's rhetoric in Europe. And I'll give you a little preview of it. They don't like it. They don't like what he's saying around Europe. They don't like his support of different parties. They don't like his outspokenness in their politics. So as a result, many Europeans, I think, are just avoiding Teslas. They're in protest. They're not buying them, even if they're the best vehicle, even if they believe in EVs and they believe in making things more green. They really hate Elon Musk's involvement with Trump, but especially Elon Musk's participation in their politics. That's something that I think a lot of Europeans are very upset with. So right now, this is one of the biggest things impacting Tesla stock. The fact that they're not selling vehicles in Europe anywhere to the same extent. Now, to put this again in perspective, if we go back to this chart, one thing that I'll just highlight here, Tesla's down 13%, while other EV companies are up around 8 to 10%. This is not a situation where Tesla's dropping because the entire market's dropping. Tesla is uniquely dropping, and that is specific to Elon Musk's involvement in politics. Recent surveys have shown an erosion in the brand's appeal, especially among Democrats in US. Some Wall Street analysts have downgraded Tesla shares based in part on the growing animosity for the brand. Global vehicle deliveries were weighed down by significant declines in some of Tesla's biggest markets. Data from government and research firms show the company doesn't break out regional results. So they're not showing whether or not the sales are declining in Texas or California, but they're probably declining more in some of their biggest markets like California. In Germany, this is where Elon Musk made many people very, very upset. With his support of different political candidates, Tesla's European factory new vehicle registrations fell 76%. That is a catastrophic fall from the year prior. So this shows that they're in active protest. They're refusing to buy Teslas. So this is a situation where investors are looking at this and noting that these sales are falling, and they're trying to determine if this is a long-term intrinsic problem with the company or if it's just short-term protesting that'll eventually blow over. And right now, investors have decided that it's a short-term issue. Tesla stock originally went down as a result of this news, but then it immediately went back up into the green by 5%. The reason that Tesla's in the green around 5% today, there's a rumor that Elon Musk could be leaving his Doge post soon. This rumor broke, and this is the reason that this stock is up today. Now, if Elon Musk left Doge, that would solve one of the biggest problems that Tesla's facing. Because again, it's not just competitive threats. It's the fact that he's actively damaging the brand by being too involved in politics. There's so many protests going on, so many people associating Tesla with all of Elon Musk's political stances. If he was to step back from politics, there would still be lingering political damage, some lingering brand damage, but over time, the intensity of it would go down. Tesla stock would have its brand slowly repaired over time as the emotions and the intensity of this simmers down. So I do think that this is a positive thing overall for Tesla. If Elon Musk steps back from his Doge post, if he focuses solely on Tesla, if he stops telling Europe on how to run their politics, the Tesla brand will recover over time. Now, we also have the news that there is apparently a bidding war going on with the big credit card companies, Visa, Mastercard, and Amex. All of them are bidding to get their hands on the Apple Card. The Apple Card is up for grabs because Goldman Sachs, the bank behind it, is getting out of the consumer lending world. For months, big banks including JP Chase, Synchrony Financial have been vying to take over the issuer. What hasn't been known is the equally fierce fight playing out between the networks to win Apple. With Visa, American Express trying to unseat Mastercard, according to people familiar with the matter. So Apple's going to be deciding what one they're going to use before they even select the bank. The card comes first. Visa, the largest network, has made an aggressive pitch to win the card, including offering the kind of upfront payment to Apple that's normally reserved for the biggest card programs. So they're trying to get Apple, and they're treating Apple like they're trying to get Costco. We know that Costco only accepts Visa card. So that's all they're accepting right now. And we don't know exactly what Visa paid Costco, but we know their agreement was a big one. This is a big whale to get when you have something like Costco. American Express is also in the mix, trying to become both the issuer and the network for the Apple Card. And people said Goldman Sachs has approached Amex to gauge its interest in taking over the card in 2023. Apple's in this enviable position to have these three companies bidding to work with them, to the extent they're willing to pay hundreds of millions of dollars. Apple makes money from the credit card companies. That's how dominant their position is. It's very similar to Costco. Costco doesn't have to pay Visa or Mastercard to work with them. Those companies will do anything to work with Costco because of the volume that they transact. With Apple, the need to work with Apple may actually be bigger because these companies consider Apple to be at the digital epicenter, a company that has all transactions going through it. That there's so many different payments being used with Apple Pay, with the integrations, that all of them want to be a part of what's the most relevant technology being used. So it'll be interesting to see how this ends up. But I think that Mastercard is going to aggressively bid to maintain this position. Now, finally, we get to this news that was thrown in late in the day. Amazon said to make a bid to buy TikTok in the US. This is according to the New York Times. Amazon has put a last-minute bid to acquire all of TikTok, the popular video app, as it approaches an April decline to be separated from the Chinese owner or face a ban in the United States. So we still have this ongoing narrative of the ban. We don't know if it's officially going to go through. President Trump has made remarks saying that he doesn't really want to ban TikTok, but right now it's still technically scheduled to go through. Now, they mentioned something interesting here. They say various parties who have been involved in the talks do not appear to be taking Amazon's bid seriously. I don't know why. They just mentioned that it was a last-minute bid, so maybe it was the timing of it. TikTok is actually a big competitor to Amazon. Social marketing and social buying and selling of products is huge. Amazon wants to own this asset, so I think they absolutely would given the chance. So I don't know why they're not taking it seriously. the people familiar with it, but Amazon does have the market position, the incentive, the motive to own TikTok. President Trump is slated to meet with top White House officials Wednesday to discuss TikTok's fate. So as of right now, even though we don't know the fate of TikTok, Amazon is one more company in the running to own it. That's going to be it for this time. See you in the next one.